Hello and welcome to another episode on futures and options. I am Kushal Lodha, founder of Kager, an education company in financial literacy, and today we are going to discuss how to adapt to market volatility in futures and options.
Let's dive right in. To start, can you explain what we mean by risk management in the context of futures and options?
Sure, risk management in futures and options involves identifying, assessing, and prioritizing risks, followed by coordinated efforts to minimize, monitor, and control the probability or impact of adverse events. Essentially, it's about protecting your investments from significant losses while trying to maximize potential gains.
That sounds crucial. Let's discuss some specific strategies. Can you start with the covered call strategy and provide an example?
Of course, let's say you own shares of company X, currently trading at Rs 2,500 per share. You believe the stock will stay around this price for the next month. You can sell a call option with a strike price of Rs 2,600 for a premium of Rs 50. If the stock stays below Rs 2,600, the option expires worthless and you keep the Rs 50 premium, reducing your effective cost basis. If the stock rises above Rs 2,600, you will sell your shares at Rs 2,600, earning a profit on the stock appreciation plus the premium. Think of it as renting out your car while you are not using it. You make money, but if someone wants to buy it, you sell it at a profit.
And what about the protective put strategy?
Let's take stock X as an example. Suppose you own shares of stock X at Rs 450 per share and are concerned about a potential decline. You can buy a put option with a strike price of Rs 440 for a premium of Rs 10. If the stock falls below Rs 440, you can exercise the put option and sell your shares at Rs 440, limiting your loss to Rs 20 per share, which is the difference between your purchase price and the strike price plus the premium. It's like buying insurance for your car. You pay a small premium to protect against a significant loss.
How about the long call strategy?
Sure, you pay a premium for the right to buy a stock at a specific price within a certain period. For example, if you believe stock X, currently trading at Rs 1,500, will rise, you might buy a call option with a strike price of Rs 1,600 for Rs 50. If price of stock X jumps to Rs 1,700, your profit is Rs 100 minus the premium. But if it stays below Rs 1,600, your loss is limited to the premium that you have paid. It's a way to leverage your bullish outlook with limited risk.
And the short put strategy?
A short put involves selling a put option. For example, if you think stock Y trading at Rs 1,000 won't drop below Rs 900, you can sell a Rs 900 put option for Rs 20. If the stock stays above Rs 900, you keep the premium. However, if it falls below Rs 900, you might have to buy the stock at Rs 900, but you keep the premium. It's like getting paid to keep money aside to buy a stock at a lower price you wouldn't mind owning anyway.
And what about more complex strategies like straddles and strangles?
A straddle involves buying both a call and a put option at the same strike price and expiration. Suppose stock Z is trading at Rs 1,500 and you expect a big move but are unsure of the direction. You buy both a Rs 1,500 call and a Rs 1,500 put. If the stock moves significantly in either of the directions, one of the options will gain enough to cover the costs of both. It's like placing bets on both teams in a football match, so you win big if the game is highly unpredictable. A strangle is similar but involves buying options with different strike prices. For example, you buy a Rs 1,600 call and a Rs 1,400 put.
Can you explain a bull call spread and a bear put spread?
A bull call spread involves buying a call option at a lower strike price and selling another call at a higher strike price. Let's say you buy a Rs 1,500 call on stock A and sell a Rs 1,600 call. Your profit is capped, but so are your losses. It's like climbing a hill with a safety net below you. A bear put spread is the exact opposite. You buy a put at a higher strike price and sell another put at a lower strike price. For example, you buy a Rs 1,500 put on stock B and sell a Rs 1,400 put. Again, profits and losses are capped, providing a balanced risk-reward ratio. It's like going down a hill with brakes. You won't slide too far.
And how about iron condors and butterflies?
An iron condor involves selling an out of the money call and put while also buying further out of the money call and put options for protection. For example, you sell a rupees 1600 call and a rupees 1400 put on stock C while buying a 1700 rupees call and a 1300 rupees put as well. This strategy profits from low volatility. Imagine setting up a trap for a wild animal with a cage. You catch it as long as it doesn't run too far. A butterfly spread involves buying one option at a lower strike, selling two options at a middle strike, and buying one option at a higher strike again. For example, you buy a rupees 1400 call, sell two rupees 1500 calls, and then buy a rupees 1600 call on stock C. It profits from low volatility around the middle strike price. It's like setting up a net to catch a butterfly. You benefit if it flutters around but doesn't fly away.
Wow, this has been incredibly insightful. Any final tips for our listeners on managing risk in futures and options?
Absolutely. First, always have a well-defined trading plan that includes risk management strategies. Second, diversify your portfolio to spread risk across different assets. Third, continuously monitor your positions and market conditions. And finally, stay disciplined and avoid emotional trading decisions. Risk management is not just about minimizing losses, but also about protecting your gains and ensuring long-term success in trading.
Thank you so much, Kushal, for sharing your expertise with us today. I'm sure our listeners have gained valuable insights into risk management in futures and options.
Thank you for having me. It's been a pleasure discussing these important topics with you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.